Hello everyone, wherever you are. We are MBA students from IPMI, and today we are going to review a book with the title The Four Cornerstones of Corporate Finance Value, written by Tim Koller, Richard Dobbs, and Bill Hyett. Please enjoy. Our team member consists of 5 members, which are Aulya, Irfan, Paul, Reza, and Zharfa.
Hello everyone, I'm Reza. Now we are going to learn what are the four cornerstones of corporate finance and how do they guide the creation of lasting corporate value. First cornerstone is the core of value. Companies create value by investing capital from investor to generate future cash flow that rates of returns exceed the cost of capital. The combination of growth and ROIC drives value and value creation. Real value of company not measured by unrealistic price-earning ratio or high EBITDA. However, according to this book, the proper way to measure the company value is by growth of the sales revenue, earning, and ROIC. Sales revenue is the real metric, while the ROIC will inform us how efficient the company allocated their capital. The second cornerstone of corporate finance is the conservation of value. It means corporate create value by generating high cash flow through improving the revenue. It's not mean only the simply rearranging the cash flow of the investor. One is company's expectation treadmill. It's highlight a good company are not necessarily a good investment, as executive is often linked to the short-term share price performance. Movement in the share price stocks reflects the performance of the company. One is the best principal owner. Business is not an absolute. Business depends on who is managing it and what the strategy they pursue. Different manager will generate different cash flow, depend on their abilities to create value. The consequences if we are not valuing value. Misunderstanding of the corporate framework will lead into the poor decisions and crisis, as happened in the year 2000 and year 2007. Many managers and investors lost sight how they drive the ROIC and ignore the sustainability of important return of capital. Stages of valuing value. Companies dedicated to valuing the value are more robust company and contribute to the higher living standard of the employee. Second, that companies valuing value will attract the best and high quality employee. Who prioritize long-term shareholder value will reward it with the stock market performance in the long term.
Investors are segmented by the strategies they take on investing. In general, there are 4 most common investors that we can find, which are intrinsic, traders, mechanicals, and closet indexers. Intrinsic investors view short-term price declines not based on fundamental changes in a company, but as buying opportunities. Traders seek profits by betting on short-term movements in share prices, where they buy the share, wait for info if the price goes up, and immediately sells the share. Mechanical investors are divided into 2, indexers and quants. Indexers or index fund manager builds their portfolio by matching the composition of an index, while quants uses computer models with no qualitative judgment in building their portfolios. Closet indexer starts with the index and make adjustment from there, knows every company in their portfolios in depth. Indexer, quants, and closet indexers are virtually irrelevant from a company's point of view because they follow rather than leading the market. The only investors that matters are traders and intrinsic investors, where intrinsic investors drive the share price and traders can surely make the market move. Now we're going to talk about a brief history of stock market and the real economy. The carefree or 1960s era, where interest rate and inflation is low and stable with an average return of 9% per year. The great inflation happens from 69 to 82, where this reduces PE ratio from 16 to 8 and resulting to 4 recessions to happen and a negative return for 14 years. The return to normalcy from 83 to 96, where PE ratios and economic growth recovers with an average return of 12% per year. The stock market bubble occurs on 1907 to 2004, which impacted the tech sector and mega cap stock, resulting in an average return of 5% per year. Lastly, the leveraging and credit crisis due to the recklessness of the financial sector that wipes out corporate profits, resulting in an average return of negative 5% per year. This history happens at the United States, which also affected the world's economy. stock bubble is defined as a time when the stock price of a company is far above the level that rational, where well-informed investors would value the company. It occurs because sophisticated investors are sometimes unable to offset the behavior of less rational investors. For example, when a company's share price has dramatically increased over the past few months because the company surprised the market with better than expected result, based solely on the strong recent performance, some investors might believe the company will continue to exceed market expectation and thus start bidding for shares. Behavioral finance has shown that many investors demonstrate this type of behavior, creating upward pressure on the share price. This is called a stock bubble because this price can pop and drop in no time.
Earnings management. Earnings are an important measure of economic performance and indicator of cash flow generation. In fact, reported earnings will equal cash flow over the lifespan of a company. Consensus estimates don't matter. The consensus forecasts are not very good. In general, analyzed earnings estimates are not accurate. They tend to be too optimistic and they almost never identify inflection points. Earnings volatility is inevitable. Conventional wisdom is when investors prefer smooth earnings growth and avoid companies with volatile earnings. There are plenty of low volatility companies with low TRS, just as there are plenty of high volatility companies with high returns. Accounting treatment won't change underlying value. Companies sometimes go to great lengths to secure a favorable accounting treatment, as evidenced by the battles over goodwill and employee stock option. From a capital market perspective, the answer is clear. As long as investors have sufficient information on the amount, terms, and condition of the option granted, new expansion rules will not drive down share price. Return on capital. Return on capital is one of the two core drivers of value creation. And what drives return on capital? First one is the structure conduct performance or SGP model. Say the structure of industry influence the conduct of the competitors, which in turn drives the performance of the companies in the industry. 2. Innovative products or services. Innovative products and services that yield high returns on capital are either protected by patents or are difficult and expensive to copy, or both. 3. Quality, a term as broadly used as quality requires definition first. 4. Brand. Price premium based on brand are often highly correlated with price premiums based on quality. 5. Customer lock-in. When it is costly or inconvenient for a customer to replace your product or service with another one, your company can charge a price premium. 6. Rational price discipline. In commodity industry with many competitors, the laws of supply and demand work to drive down prices and returns on capital. 7. Innovative business methods. A company's business method is the combination of its production, logistics, and how the product or service is delivered to the customer. 8. Unique resources. Sometimes a company has access to unique resources that cannot be replicated, which gives it a significant cost advantage. 9. Economy of scale. Scale can be important, but usually only insofar as it operates at the local level, not the national or global level. In other words, it's better to be number 1 in 10 states than to be number 1 nationwide but number 4 in every market. 10. Scalability or flexibility. A business is scalable or flexible when the cost to serve additional customer is very low, and usually this entails the delivery of products and services through the use of information technology. And the last one is return on capital sustainability. Central to value creation is understanding the sustainability of ROIC. In a perfectly competitive economy, returns on capital over the cost of capital eventually get competed away. Growth. Different growth creates different value. Revenue growth comes in 4 types: market share increases, price increases, growth in an underlying market, and acquisition. Each type can be further broken down into subtypes. For instance, you can increase market share by either lowering price or improving efforts to market and sell your product or service. Growth requires continual search for new markets. Sustaining growth is difficult because most products have natural life cycle. To sustain high growth, companies need to overcome the portfolio treadmill effect. For each product that matures and declines in revenues, the company needs to find a similar size replacement product to stay level in revenues, and even more to continue growing. But finding sizable new sources of growth requires more experimentation, and a longer time horizon through which many companies are not willing to invest.
Good morning, everyone. I am Irfan and I am here to talk about business portfolio and risks. Deciding what business to be in is clearly one of the most important decisions executives make. Before deciding which business to be in, the executives must see the best owner principle, which are distinctive access to talent, capital, government, supplier, and customers, better governance, better insight, unique links across businesses within a portfolio, distinctive skills that the company can bring to most of its business units. Best owner principle states that different owners will generate different cash flows for a given business based on their unique abilities to add value. And cash flows is everything for the owners or shareholders. While adding portfolio of the business, there might be some diversification happened, and diversification is neither good or bad. This depends whether the parent company adds more value to its business than any other potential owner could. Also, benefits of diversification are contrasted with real costs, including added complexity and bureaucracy, as well as slower responsiveness to opportunities. The ultimate test of diversification is the effective operation of each company in the portfolio. Besides adding the portfolio, the owners should be agile as well in divesting its portfolio. Divestitures should consider the cost to the parent, cost to the unit, and the best exit price. Mergers and acquisitions. Acquisitions is transaction wherein one company purchases most or all of another company's shares to gain control of that company. While mergers is an agreement that unites two existing companies into one new company. Acquisitions create value when the cash flows of the combined companies are greater than they would otherwise be. Three characteristics of successful acquisitions. The first one is strong operators are more successful, low transactions premiums are better, and then the last one being the sole bidder helps. The final chapter from me is about risk. There are three types of risk. The first one is internal risks, such as employee and customer safety and also pollution. The second one is natural disasters, such as flood and earthquakes. The last one is external economical risk, such as inflation, recession, and prices of commodity. However, some risks should be faced rather than avoid, such as Heineken's decision to export its goods to America. While all operations are done in the Europe, Heineken is risking currency risk because people in America pay in dollar. This risk should be faced in order to gain more revenue rather than only stay in Europe.
In chapter 15 to 17 of Corporate Finance, talking about financial strategies and decision making, the part begins by highlighting the significance capital structure decision, specifically introduction. Capital structure decisions are vital for companies, and wrong choices can lead to significant value destruction. An historical example of 2006, proposal from investment banks to increase debt significantly, and no company adopt this approach. A fortunate decision given 2008 financial crisis. An objective of capital structure ensure sufficient capital for strategic goal, mitigate potential cash flow shortages, and three key issues in capital structure: optimal mix of debt and equity, use of capital structure, combination of dividends and stock buybacks, and debt equity mix. Balancing act. Debt provides flexibility, equity provides resilience. The following begins by acknowledging and determining the value of investor communication, such as challenges in investor communication, difficulty in determining investor communication value, and shortcomings in interpreting short-term stock movements. And second, goals of investor communication is gaining intelligence about customers, competitors, and suppliers. And third, importance of intrinsic investor, prioritizing interaction with intrinsic investor and providing detailed information to sophisticated investor, and transparency in communication, encouraging transparency in financial reporting, providing operational metrics, sharing details about strategic decision making, and questioning earning guidance, doubt about the effectiveness and benefit in issuing earning guidance, and potential negative consequences of providing earning guidance. The last section starts by placing the responsibility on CEOs, particularly in large corporations, to balance the pursuit of short-term revenue growth with sustainable long-term value creation. In particular, value management can be explained certainly with challenges in creating value and common pitfalls. And second, organizing for value. Unit management pitfalls. Large company may face risk in unit management due to operating at high levels. And third, performance measurement. Shortcomings of traditional metrics and relying on accounting profit. 4. Compensation balancing subjectivity. Evaluation processes should be fact-based rather than formulaic. And strategic planning and budgeting. Collaborative budgeting, aligning corporate and unit level planning involves collaborative processes, avoiding top-down targets and understanding of each unit's potential. Board of Directors. Board's role in value creation should see focus on overall financial results to evaluating individual unit performance.
That is the end of the video. Thank you so much for watching. Don't forget to comment, like, subscribe, and share to your friends or colleagues about the 4 cornerstones of corporate finance. Thank you!